Back with closing trades right here in ET now, and we've breached that 24,000 mark for the Nifty futures as well. Just a short while back, 400 points of a decline is what you're seeing. And it's clearly financials and autos which are weighing heavy on the markets. Other than that, of course, automobiles, telecom, FMCG as well are really not supportive. Perhaps there's only pharma and oil and gas which are a smidge in the green or relatively better than what the other sectors have been doing. But let's welcome on board Sunil Subramaniam as well and find out what he recommends doing in this market right now. Sunil, hi, afternoon. Welcome to the show. Sunil, what explains this incessant weakness, especially in the private banking names? I mean, ICICI Bank, HDFC Bank, the list can go on.
It's a combination of three factors, all related to FIIs. So the first is that I think there's passive money flowing out of emerging market ETFs and with India-specific ETFs. So the banks being the largest weight in the index, fund managers don't have a choice in passive funds. So I think there's a 30% drag on that. That's number one. Number two is that the speculative activity, because there's a risk off on India, there's a huge, Bank Nifty future they're shorting. I think that contributes again to the bank's thing. The third aspect is that they're also specifically taking stock futures negative. I know this is all technical, but that's what I've got to understand, that this is the combination. And you have to layer this with the fact that DIs are booking profits when the FIs are, DIs are not buying it because they've already stocked up a lot on the banks over the last 1 year, 1.5 years. I don't think they have an appetite to take on more of the banking which the FIs are selling. So I think this lack of support from DIS and this diverse range, and essentially what we are then talking about is that it's sell India on rise for the FIs, because the India is the biggest single impact of an oil price in the entire greater world, right? We are the ones who are 85% of oil. So the perception. And what happens is that the fact is that there's a lot of algorithmic trading going on. So when you then, for India-specific factors which are fed into a computer to say this triggers a sell-off, this triggers a stop buy, stop loss, whatever, oil-related matters are a significant part of that. So any sensitivity to that leads to a sell of India. It's a pack. And I think banks are suffering the load. Finally, of course, is that the strong dollar is not helping. The rupee again today is weakened a little bit. Yesterday it strengthened a little bit. Today again it's weakening. So I think that's again makes the short-term trader sell India. And banks, unfortunately, because they're 30-35% of the index, have to bear the brunt of the sell-off.
That indeed is the case. But do you at all, Sunil, recommend buying in this current decline or at least nibbling in, or would you say wait it out?
I think nibbling in is the right approach. I think that I'm saying that if you have free cash flow in your hands, put 1% every day into the markets. And I would say buy in proportion of your holdings before the geopolitical crisis started. This particular one started, right? You have built up the portfolio with a certain view. I don't think India's view of that has changed. Yes, short term, there'll be impacts on GDP. Short term oil related sectors may get more impacted. But I expect that oil is an extremely V-shaped phenomenon, right? It falls sharply, rises sharply, falls sharply, rises sharply. So, the ECG chart of that would make you immediately have a heart attack. So, as far as that is concerned, I wouldn't get worried about that oil prices are hiking, because when all the dust settles, they'll come back. But I don't want you to then go and take a big bet on oil, because it could go much higher. It touched 116, 17. It's come down to 85, now back to 90 plus. So the volatility is just too much for you to play the field there. My recommendation is that whatever you feel is a medium-term portfolio allocation before this whole Iran, Israel, America triumvirate action started, right? I would say the market, when it comes back to its normalcy post this crisis, it'll again build back on what we felt was good for India. So to that extent, I would say don't have to fresh think about it today, but what you had before, start nibbling at it, start buying, and 1% a day will make your free cash flow last 100 days, which is 3 months, which I think is as far as I'm concerned, the outermost that this war will last as an impact. I think the pressure is too much on Mr. Trump with local gas prices, on Israel to bring a conclusion, and on Iran to get back life to some stability. So I see that in a 3-month time frame, the war will get settled one way or the other. So this is a very good way of averaging out your portfolio. And so, just to summarize, I feel you should continue nibbling.
Good strategy there, Sunil. But what sectors would you say that one should start with?
Well, obviously, it depends on your risk appetite. If you're an aggressive person, I would say actually go and buy the oil related impact because we know that oil is just sentimental. The Hormuz Strait closure is a huge thing. We can't expect it to continue for too long. This oil related thing can't continue for too long, right? Like I said, 3 months. So, whatever gets hurt by oil is going to bounce back. So, if you have the stomach for it, and if you have the stomach for another 10-15% downfall in the prices of whatever you buy, if you have the stomach, keep buying those because they are the ones going to bounce back the strongest. But like I said, in Hindi, jigar chahiye. But if you're not like that, if you're a moderate, well diversified investor, then stick to the non export, non or external related factors. So, again, banks for me are a good buy at these prices which are falling because I don't see that the Indian economy's downfall is going to be so great because of the geopolitics that banks are suddenly going to see huge losses or whatever. All of this is just that it's a good profit booking. Even for an FII, he's made a lot of money from the whatever they had put in PSU banks and banks. So they're booking profits. So I think something which was valued at a particular level before, I don't see why it shouldn't come back. So if you're moderate, I would say hang around the banking, financial services, and the consumption pack. And if you're aggressive, you can actually go and take calls on the oil impacted sectors. So I leave the choice to the risk appetite of the investor.
Makes sense. Well, Brent is
Nothing to be done
already.
in a 3 month time frame, please. If you have a 3 month outlook, keep quiet. Go watch the movie. Durandar 2 is releasing in a few days.
Have you booked your tickets? Sunil, I'm guessing you must have already booked your tickets, haven't you?
Of course. First day, first show, I will be there.
Same. Well, I guess when you're in the market, that's what you need to get your mind off, right?
Absolutely. This is the best time to de-stress yourself.
Yeah. Okay, 4 hours. Enjoy. Goods, for instance, we were just talking about with Kunal, they're holding up well. In fact, look at a Blue Star, it surged up about 3%. You've got a Voltas, etc. as well, which have been looking very good. Symphony is the other one, which has been holding out well. And this is not restricted to today's move. In the last 15 days itself, these are stocks which have been propping up. Sunil, any of those weather-related themes that you would be betting on? Anything from FMCG or, for that matter, white goods?
No. Yes, of course. Like I mentioned, no, consumption is a fact that we should be backing here. And because you see, remember, when all the dust about the thing settles, the consumption sector, barring auto, has not felt the full relief of the GST yet in its numbers or in the market appreciations. So I think consumption is still the story to play. The GST cut is real. There's no sentiment involved in it. And I think that it'll start playing from consumer durables, cooling related durables in the summer, through to all the rest of the festive season starting, we'll see the non-auto pack of it really starting to benefit. And I think so domestic growth numbers from there will be pretty strong, right? Just keep in mind that their immediate margins might get affected because of the oil thing. Some of them do have crude related derivatives in the manufacture. So just from a short-term EPS, they might not be up to expectation, but that's okay. The sales numbers, because they're highly operating leverage companies, the top line growth will be easily, much more beneficial from an EPS growth perspective. So yes, for me, bet on the full consumption pack, I would say at this stage.
Interesting. Well, Keynes, that's the one.
With regard to EMS, Sunil, I wonder how you're playing the entire data center and AI theme, if at all there is any way to play that from an India equity investor standpoint.
Well, I mean, you could have a slightly medium-term outlook. It's ultimately going to be the Indian software companies which are going to execute these data center-related matters, right? They have the domain skills, they have the employee strength. So, but it's in the near term, they are a negative of the AI win, but they will turn positive. But you got to have patience to do that. Other than that, the only other way to play the data center is a real estate pack because there's going to be huge demand for corporate real estate. So that's one way to place. It's not directly AI related, but the spin-off benefit of that will come through that. So other than that, I don't think that a lot of these data centers are going to be a listed place in the Indian stock market. So it's just going to be an overall spillover impact there. So for me, like I said, IT with a medium-term approach and real estate.
Right, just monitor.
To Interglobe Aviation in particular, what's the view there? I mean, we've seen a significant decline from the highs. Give us a sense of where you sit at in terms of a view.
I just spoke about it from the airline perspective. If you're an aggressive risk taker, I think it's worth doing it because both those impacts which are seen on the airline sector, which is the fuel price rise as well as the ban on the air travels, are short-term phenomenon. And Air India, with the launching the surcharge, means that Indigo and other airlines will follow suit. So they are protecting their bottom line. This is not good news from the flyers in the country, but it's good news for the companies, right? So I would say that they are doing well to defend themselves by at least partially doing this. So to me, like I said, it comes from, if you're an aggressive bet taker, then I would say from a medium term, all this correction has been good because this is an extremely panic reaction to a very, very deep geopolitical event, but which won't last forever. So I think that one has to buy expecting the normalcy. The million-dollar question is, when will the normalcy arise? So if you have a time limit in mind, 3 months, 6 months, don't touch it. But if you're in there for the medium term, then these prices are probably very good bargains for you to buy it.
Interesting. Sunil, let me come to you with regard to auto ancillaries. And this has been a very decent play over the last, maybe 4 to 5 months because it's very closely linked to OEMs. Would you, at this point, play auto anch over the OEMs? Is that how one should position themselves?
See, that's a very tough one because, like I said, auto, barring the recent correction, had seen a very strong rally in the back of the GST cut-led boom. And auto anchs actually were more dependent on an export-oriented thrust from the EU deal as well as the American deal. Now, the American deal is effectively on pause, and we'll have to wait and see how that pans out. So from that point of view, I think that I would at this point of time have wait and watch on both auto OEMs and auto anchs.
Okay. Kunal, M&M in particular, do you have a view on that one? Because we've seen how the stock has moved all through this week. I'm trying to understand whether there are any fresh bases that have been created and whether there are enough support levels there to kind of trade this one.
See, price-wise, the stock is below 200 DMA. It's below the 50-day moving average. And all of those key price points are of support for itself. But as I was pointing out earlier, that the RSIs for many of these stocks are much higher. I'll give an example. For example, in the month of Jan and Feb start, when M&M was at 3,400 levels, it coincided with the 200 DMA. The RSIs at that point was closer to 34, 35 for M&M. Now the prices are at 3,200 levels thereabout on the spot basis, and the RSIs are at 39.40 for the stock price. So you see that relative strength which is there into these stock prices. This indicates that maybe these stocks are in the process of finding a bottom for themselves. Sometimes it takes weeks, sometimes it takes few days, depends on the kind of market scenario. But I believe that those are opportunities where traders generally try to add or average more quantity, accumulate more further. I think that should be the case for many of these auto stocks, unless you're looking at a point where the current crude oil based scenario and what's impacting India specifically, I think that takes into a different proportion altogether.
Well, 23,858 now on the Nifty. In fact, the breadth of the market has worsened quite a fair bit. 166 point stock standing to the red as we speak, if not more, on last check within the FNO pool itself. So that's a little bit worrisome. 176 stocks now, I stand corrected, and only 35 standing to the green, which are largely Nalco, Premier Engine, Supreme Industries, Blue Star, and of course Oil India has strengthened further, which is now holding up a good 2% as we speak. But Sunil, within the entire PSU pack, and let's exclude banks right now from the list, what is it that you're liking?
On the PSUs, I'm not sure that I like anything in the PSUs.
Okay, fair point. But Kunal, your observation is that it's actually the PSE index which has been doing very well, right? And ex-banks as well. What's a good trade to take for a slightly longer term?
Yeah, so there are a lot many PSU stocks which apparently have been doing very well for themselves. The likes of MCX, BSC, the defense names, Coal India, NTPC, ONGC, etc. When you try and look at these charts over the last 3 months or 6 months, they've been very, very strong. And that's one of the reasons why you've seen that the CPSE index has done very well for itself and it's managed to shield from the overall market trend in the last, I think, couple of months specifically. I would still believe that ONGC, NTPC, Coal India, they are very strong breakouts. We've seen weekly and the monthly charts turning for these stocks in terms of indicators. So unless there is something completely dramatic negative for these stocks in terms of news flow, it's going to be difficult for these stocks to try and reverse this trend. Yes, there could be a pause which could be there in between because of the news flow being attached to the stock prices. But eventually, I think the structure, it plays its part, and the stock prices, they tend to eventually move up higher. From the defense pack also, I think BL is something which I've been recommending. That's a name which one could look at, and specifically, I think trying to take advantage of these corrective phases. If these stocks correct 7% to 10% broadly from their swing highs, and BEL was almost at 460 levels plus a couple of days back. So correcting from those high levels, if these stocks come back towards a good support level, support point, it's a very good zone to try and go for an averaging out.
Okay, all right. Sunil, within the power space, see some of these power financiers, I was just looking at the flash at the bottom of the screen, REC, and we have these PE ratios now flashing. REC is at 4 times earnings. That's what I was, really seeing. You believe that starting to look interesting, and this is trailing 12 months, of course, the PE that's reflecting, but starting to look interesting, some of the power financiers?
Yes, I think so. They are starting to look interesting because I think, see, power is a good story overall. And rather than the actual power players, the PSU, the financials are, I would say, a better bet because with all the data center you mentioned, the other thing which data centers need is a huge amount of power. We know that this whole AI revolution needs power. So I think that to that extent, the demand for power is going to be very, very high. And financing this whole capex creation there is a big, big story there. So yes, I do believe that the power financials are beginning to look attractive.
What about charts, Kunal?
See, from the power stocks, NTPC, of course, and Power Grid were the two names which have been doing very well. Tata Power today, for the first time, has managed to come back above the 200 DMA. I think the stock was at 389 or 390. That was the 200 DMA for the stock. I'm not sure whether the stock would be closing above those levels, but even if it's a breach, and maybe a couple of days, if we see that confirmation happening for Tata Power, that could be another stock which could be added to the list.
And sorry, REC, PFC?
So REC, I think, post that news flow from the budget day, that stock has been a huge underperformer. So there was a point where REC was one of the stronger names from the power financiers. PFC was second rung. Now that those tables have turned, you're looking at PFC as a lot more stronger. The stock holding on to 410, 415 mark broadly. REC is sub 400 mark, and that clearly tells you that the underperformance is still there.
Okay, let's begin winding up for the day then. Sunil, we'll let you go on that note. Kunal, good to have you on the show as well as always. Well, we're closing